I feel called in my life to say, hey, first of all, building wealth is not that difficult. Yes, there's risk to doing it. And if you're following a lot of proven methods, there's alternatives that will help you beat the game. To do that, you got to get out of single digits, which means 401ks and IRAs. It's not really actually the solution that's going to lead to the dream life.
Welcome everyone to the Directed IRA webinar. This is a special Directed IRA webinar and Directed IRA podcast because we are here in Krohn Studios. We are in Kris Krohn Studios. This is the first time we've ever done this and gone on location to do a webinar, but there's a reason we did this, because I need you to come on to Kris's territory to debate. I'm going to introduce Kris here in a moment, but I'm super excited for today's webinar because he's an expert in investing in real estate. He is super smart. He's got a ton of experience in this. He's been down the road. He's made the mistakes. He's learned the lessons, and he's literally trained millions of people. Like, he's getting millions of views weekly talking about how to grow and build wealth in real estate. And so now he's a critic of IRAs and 401ks. So we're going to get to that, and I told you guys we're going to debate that topic. So hang with me here because I'm super excited, but I want to make sure you guys know who Kris is first. Now, a little bit of housekeeping. We're going to use the Q&A feature for questions. Do not chat questions. We're going to take some questions, but make sure you're using the Q&A feature. Aaron, our COO, is here. He's going to be monitoring that. We're going to be pulling in questions here as we're going through. But we're going to be doing a lot of learning here from Kris after we finish our debate. Now, let's go to the disclaimer. This is Attorney Matt. Attorney Matt's pretty boring. I know you don't want to party with Attorney Matt because he's a total buzzkill, but Attorney Matt needs to give you a disclaimer for a second, okay? This is all meant to be educational in nature. Everybody's making your own investment decisions. If you want to seek out professionals to get professional advice, seek them out, all right? But this is meant to be an educational event. So please take it into that context, not attorney-client privilege. We're not giving you investment advice. Everybody knows when you're self-directing your retirement account, you are the one making your own decisions. All right, now let me tell you guys a little bit about Kris. For those of you that have been living in a cave and don't know who he is, Kris Krohn became financially free at 26. He has over $2 billion in real estate, 6,500. I'm like having to read the stats because I want to make sure I get the numbers right. 6,500 homes transacted, owns over 400 businesses, 5 books. He's got a new one coming out right now. We are just hearing about, super excited about. Hosts over 1,000 events. This is what I said, millions of weekly views in his content. He's created many millionaires, and he has a foundation that he participates in that saves lives. So, Kris, I am honored to be here in your studio, excited to be debating this topic with you. But what is the deal? What's your beef with IRAs and 401ks?
Okay, Matt. Well, listen, first of all, just welcome everybody. I'm really happy to be here. And Matt, really great to have you and your team here in the studio today. And it's true, like if you watch any of my social online, I'm kind of known as the hater of 401ks and IRAs. But really, the big problem there, Matt, is that most people, they put their money in a 401k because they're told to, and it's because their company's giving them free money, right? This match. And so they're thinking, this is free money's better than no money, so this will take me somewhere someday. And then your CPA says, hey, would you like to save $600 this year in taxes? Let's take whatever little left you had and throw it in an IRA. And so people are doing this IRA 401k thing, and then they fast forward 40 years when it comes time to retirement, and you look at what they've saved up, the average 65-year-old, $221,000 that's now accustomed to living off of $94,000 a year. You run the math, they've got like 2 to 3 years worth of money at most, probably just right around 2 years. So Matt, like it's a nightmare because most people won't get serious about looking at the math until they're in their 50s, maybe 60s. Guess what? It's too late. They lost their number one asset, time. So I feel called in my life to say, hey, first of all, building wealth is not that difficult. Yes, there's risk to doing it. And if you're following a lot of proven methods, there's alternatives that will help you beat the game. To do that, you got to get out of single digits, which means 401ks and IRAs. It's not really actually the solution that's going to lead to the dream life.
Yeah, so everybody knows, I mean, I'm always talking about how our audience here, there's $33 trillion in retirement accounts in the U.S. And it's like, I always say there's no more money anywhere to invest in anything than U.S. retirement accounts. And so a lot of people are stuck in what you're talking about, Kris. You know, I got 200,000 or so, let's say, in an IRA or 401k. Well, let's talk about what's the problem with it. Because you're right, people are getting to 60 and they don't have enough. They're not going to make it. We all know Social Security is not going to cut it, right? So what should people be doing? Well, I mean, you're always talking about real estate, but like, what else?
But before you can even actually solve the problem and take a look at 401ks or IRAs or anything like that, you've got to actually pause and actually ask yourself, what is your financial planner going to advise you to do when you get to retirement? Well, if you used their system of 401ks and IRAs, then you're going to give it to a financial planner who's going to annuitize it. They're basically going to give you off of the 3 or 4% rule, whatever you've got there, and that's going to translate to like $400 or $500 a month. And that's kind of scary, but you got to ask yourself, can I live off of $500 a month? And obviously the answer is no. Like no one that's living off of $60, $70, $80, $90,000 a year dreams of dropping that down to like $20 or $30,000 a year. It's terrifying. Yeah. And yet if you take your money and you self-direct it, it's like there's a whole world of possibilities out there. Like I was retired at the age of 26. It took me 4.5 years, and all I did was buy 25 rentals. 25 rentals that each had left over of $500 a month meant that I was coming right out of college with a passive income of $12,000 a month, and I didn't have to get a job. Like I was free. I basically arrived super early at that game, but I'm into private equity. I'm buying companies. I'm buying companies that have really huge upside. There's alternative investments. There's all sorts of things that you can do with a self-directed account that you just don't get out of a 401k or IRA.
See, I knew we were going to agree. I just didn't know it was going to be so fast. Because the self-directed IRA and 401k.
If we're going to agree, man, then let's get pissed. Like, let's do that. Let's get angry at the system.
Yeah. So, and we know it. It's Wall Street and the insurance companies, right? I mean, they're the ones that have been selling all these products to everyone's IRAs or 401ks. Nobody's excited about it, right? How many of you are excited about the mutual fund or ETF that's in your IRA or 401k? But what Kris is always talking about, and what I wanted to do this webinar with you, Kris, is because I know you're passionate about real estate and investing in real estate. Private equity. I mean, these are the asset classes that we love and we see every day at Directed IRA. I mean, every 15 minutes, someone in our office is investing in a real estate deal or a private equity deal with their IRA or 401k dollars. And so those of you that are new here that have not done this yet, you don't have an account yet, we are trying to educate you today on what are the options and possibilities in building this in an IRA or 401k, or we're going to be talking about real estate today, outside of it too. I mean, building wealth is not just about your IRA or 401k. Yes, we happen to do that directed IRA, but I own real estate outside of my retirement account. I own businesses outside of my retirement account, but I also own it in my retirement account. And so what I'm focused on, and I think what everybody should be, whether it's inside your IRA or 401k or outside of it, is what is the investment asset you're buying? What is the asset class? And the problem has been IRAs and 401ks, everybody's just been brainwashed by Wall Street that you can only buy what they happen to sell, right? And that's just not the reality of it. So, our content on real estate, but I wanted to get Kris here because I'm not an expert on real estate. I've told you guys that, and I call myself the base hitter. I'm the base hitter, but base hits can win games, guys, So, but I wanted to get Kris here because he's an expert on it. Now, I think I'm just going to let you go into lecture mode, Kris, because I want to learn from you, actually.
All right.
So I'm going to kind of turn it over to Kris. He is our guest expert today. Aaron and I are going to be looking into the Q&A. We're going to be hitting some questions here. But I think it's just going to flow best to just let Kris just run and teach.
Well, Matt, thank you, brother. And let's kick off the conversation with just this word that we are all accustomed to now. It's inflation. And inflation is bad for soft money accounts. It's bad for IRAs and 401ks. But it's beautiful for hard assets because while everyone is freaking out that the value of their dollar is going down, guess what happens to the hard assets? Their value goes up. So we're going to talk about the game of real estate today, and I want to start by actually taking a look at some really important numbers because I want to make it a point. If you read the top there in black, it says traditional retirement plans like 401ks, IRAs, they're going to average a yield of 6% on their 30-year average. And $50,000, let's just use that number. Let's say you got $50,000 sitting in a 401k and IRA. What happens if your blended average is 6%? Well, over 20 years, it triples, turns into $160,000. What happens, however, if you graduate from single digit to double digit and you move into real estate where on the very low end, you're just doing 25% on your money? And by the way, I will show you how easy it is to do 25% a year on your money, but that same $50,000 sitting at 25%, over the same 20-year period of time, it doesn't triple to $160,000. It turns into $4.3 million. That is a 27-to-1 increase. And if you're like, yeah, but Kris, I don't know if I want the 20-year game plan. Well, then let me show you what I do in real estate. My average is around 34%. What is $50,000, which by the way is enough to buy a single investment property out of a self-directed account. $50,000 sitting at 34% over that same 20 years doesn't turn into $4.3 million. Turns into $17.4 million. That's 348 times more money than a 401k. which is why 90% of all millionaires, they do it in real estate. You've read this. And so I'll just show you some of the deals here like that I'm going to be pointing out today. This is a home in Florida. I know that for those of you that like numbers, I'm going to give you access to a lot of numbers today. But if you'll just look at that little red box in the bottom right corner, the total ROI, that last number you see is 32.55%. And if you ask yourself how long does it take to double my money at that ROI, it doubles every other year. This is a property with a 37% ROI that I bought in Florida. And this is one with a 40% annual ROI. I am showing you typical deals right now. These are not different, but it is to make this point. Like, real estate is a really great investment. And I buy a house every single day. I have a team that literally goes out into the top markets. There's 324 markets that make up the United States. I'm only interested in the top 5 markets. And then I basically go there and I buy real estate. And so every day my portfolio increases at least one house or more. And that's because I'm building a $1 billion portfolio, and I've got some huge plans with my foundation on how I'm passing that wealth on. But I've been doing this now for the last 20 years. And what I'm gonna do is I'm gonna dive into the numbers and then help you understand this. How do you get in the game of real estate without picking up a second job or sacrificing your career or your extra family time? Because there's a way for this to be entirely passive for you. And I do want to do a little market update. Matt, can I talk a little bit about what's happening with the market and the recession that people say is coming? I'm like, it's here.
Yeah, you've got to talk about it.
Yeah.
So let's hit it.
So we know that the stocks and crypto markets, they are down considerably. Right now, if you actually take a look at Bitcoin and where it's at, if you take a look at performance on the asset class of just IRAs and 401ks, it's just bad news bears, which is why it's so important, I think, with directed IRA that you have awareness of like, wait a second, like now's the time to really consider your alternatives. Real estate, on the other hand, when we experience a recession in the market, only 2 out of 5 times does that correlate with real estate. Real estate is facing a very, very different game. 2008, you guys remember, if you were there, everyone said, this is the worst of times. I went crazy. I went into Vegas, I went into Phoenix, I went into Florida. I started buying homes for $100,000 that were selling for $300,000. And guess what happened after 5 years of a surplus of real estate? When population continued to increase, but we stopped building for 5 years, those prices came back. And me and my investors cleared over $100 million in profits. My number one regret, I wish I had bought a lot more real estate. So I said, the next time we're in a recession that lines up like this, even though this is here for a different reason, I'm gonna do the exact same thing. I'm buying as much real estate as I can right now, because guess what? This is my prediction. If you understand that to control inflation, what has the Fed done? What has Biden done? He has increased our interest rates and basically doubled them. And if he wants to be president or even have a crack at it, good luck, then what he's going to have to eventually do is lower those rates. So Rocket Mortgage is projected in 2024 that rates are going to be coming down by the end of 24 to 4%. Now, I want you to imagine what happens when you're missing over 6 million homes in this country and rates come down and all of a sudden they can shave $1,000 off their payment. Prices of real estate are going to soar. Barbara Corcoran agrees they're going to go 100% through the roof. So I'm buying as much real estate as I can right now because of what we're forecasting in the market. By the way, real estate is year over year actually up from where we're at right now. So real estate, is it in a recession? Completely different than actually what happened. In this recession, it's going up in value. And then, of course, this is like a big trend that most people don't see coming. You have a number of these companies like Blackstone, JP Morgan. They are collectively putting $50 billion out into the single family market because they know it's going to happen over the next 20 years. Since 2008, we never caught up from the missing supply of homes. And so the demand is so big that it's going to take more than a decade to resolve that. And so what are they doing? They're going in and they're buying as much single family homes as possible. It is predicted by 2030, the prediction is that 10% of all single family homes are actually going to be corporately owned. So they kind of want to own everything. They want to own your car, they want to own your house, and they just want you to rent everything in life, right? Kind of scary, sounds a little bit like the Matrix. So what I'm going to do today, Matt, is I want to talk to all of you about a book that I wrote 20 years ago where I basically argued mathematically with an algorithmic formula that there was a single best strategy in all of real estate. This is the first book that I ever wrote, and I basically said, show me the strategy in real estate that is the best based on the least time, least effort, least risk, most profitable, works in up and down markets, and provides the most service to the game of real estate. And it turns out that this was how I was going to create the ultimate ROI. If you purchase single family homes, at least 3 bedroom, 1 bath, but generally 4 bedrooms, 2 baths, maybe 4, 3, you buy them on a short-term 3, 5, 7 year hold, you buy them below the median, you get a 25% minimum ROI. And that is what's going to multiply your wealth beyond anything else. And so real quick, if I can, Matt, here's just my story. I bought my very first house. It took me 14 months to save up $5,000. I was poor. I was a college kid at BYU here in Utah. I had found on the third day of college my wife. We ended up marrying 10 months later. And what ended up going down is 14 months of saving. I put $5,000 in the bank, and that was enough for a 3% down payment on a tiny little bungalow with a basement apartment. A year later, I borrowed some of that equity with a home equity line of credit for free, put it in my second property, refinanced the second property, bought a third property. This is what's called house hacking. Now, after my third property, something really cool happened. My father-in-law basically said, I don't get you. I don't know why you're buying real estate. Like, I don't even know why a college kid with an undeclared major is buying one home, let alone 2 or 3. But after my third one, track record. After my third one, he said, I think you might be onto something. He called me up one day and he was crunching numbers and clicking the calculator and he was figuring out my ROI. And after the conversation, he said, let me pull money. Let's start using my IRA. Let's start using my 401k and let's start putting them in real estate. Well, we got up to 5 homes. We got up to 10 homes. And then I started attracting other partners. And before you know it, by the time I graduated college, I had 4 other partners that were all buying homes on a regular basis. I had 25 homes by the time I graduated. And those 25 homes with my cut of the cash flow gave me a basic 6-figure residual income. And basically I was free to live my life on my terms and do whatever I wanted. And that was the beginning. Like the next year, 25 homes became 50 and then 100 and then 1,000 and it just kept on growing. And basically it's been a really wild ride. Now, here's where this is relevant to you. I have created a document that I'll happily give everyone here at the end of this. It's called Krohn Consortium. It is an explanation for the single best strategy in all of real estate. I basically took my first 5,000 acquisitions, which at the time was close to $2 billion in real estate, and I basically proved how you listening can very passively, without adding workload to your life, can average at least 25 or 30 or 35% a year on your money. And it's a really great alternative. And so this document I'll give you at the end. For those of you, if there's, I don't know if we can call it out in the chat, but if there's any of you that I would call an oracle or a blueprinter that likes to see the spreadsheets and the numbers.
We've already had a question of someone asking for it.
I'll give this to you at the end before we go into Q&A. And when you download it, it will give you all of the evidence, proof, the entire system, and the step-by-step of exactly how I produce that ROI. Because for many of you listening here, buying one home at 25% average ROI, remember where that will lead you in 20 years. $4.3 million. And listen, that's not rich, but it's enough for a lot of people to say, I retired well. Now guess what happens if you buy 2 homes? If you buy 2 homes, now we're talking about $8.3 million. Or if we're talking about 4 homes, now we're talking about $16, $17 million. But that's at a 25% ROI. I've got people around the world that will partner with me and we start actually growing and compound money at a much higher level. So we'll talk about that too. All right, so what does all this mean for you? Real simple. If you're looking for the best returns, start investing in real estate. And I can get that it can be intimidating, but I think the guide I'm going to give you and some of the training and knowledge is going to remove that intimidation. So this is my growth wheel, okay? There's creating wealth, managing it, and protecting it. And to produce the kind of internal rate of return that I'm talking about, we've talked about a specific strategy. I'm going to talk about how you locate certain markets. And then my acquisitions process, and there's a way to have all this done for you. But once you purchase the house, then you get into the management mode, which is, all right, we're gonna put it on a 30-year fixed mortgage, no other mortgage type. This is a system. We're gonna have it property managed. We will do all the accounting, the financials, the market data reports, and basically do all the tax strategizing, because some of you, drop it in the chat. If any of you are paying more than $10,000 a year in taxes, owning a bunch of single family can eliminate that one pretty quick. And then finally, the third step here on protecting your wealth, this is about the right kind of insurance, doing your rent increases, managing the property, and then learning when to sell it and trade it up for more through a 1031 exchange so that you don't ever have to realize the profits in the government's eyes. All right, so this basically there's 4 profit centers in real estate. Might be a little bit new for some of you, but here's what it looks like. On the top left corner, net cash flow.
And let me just chime in here so everybody can conceptualize this.
Yeah.
Because we're talking inside an IRA or 401k and outside an IRA or 401k, and owning it personally. And so when Kris is talking about the real estate investing strategy, some of these benefits, like what you're hitting next right here, Kris, I mean, you're owning real estate personally.
Yes.
I mean, we're weaving in, you can own it in an IRA or 401k. Well,
yes.
I freaking love that.
Yeah.
But we're talking about some of the benefits of real estate. Now, like appreciation, cash flow, Those are universal themes of real estate ownership, which are the big two drivers of value that you're going to get personally or if you own it in an IRA or 401k. But some of the tax stuff, the depreciation, I just want to make sure everybody understands this. IRAs and 401ks don't pay taxes. And I always get this question, and I know you're about to hit this on the slide, which is like, but Matt, I don't get the depreciation expense. Now, personally, I want you to get a depreciation. The IRS makes you file a 1040 every year. You have to pay taxes on the income you make. Depreciation can help offset your taxable income. But in an IRA or 401k, there's no 1040.
You already got the benefit.
You're in a no-tax world.
Yeah.
And so I don't need depreciation. There's nowhere for it to go.
Yeah.
So I just want to hit that because I know some people we're weaving in inside and outside. So
no, and I think that's important. I think let's actually hit that right here. That's really important. So on the top left corner, your cash flow, it doesn't matter whether it's in or out. When I do my ROI, generally 3 or 4% of my ROI is going to come from that. And I really want you to understand how we get to an internal rate of return of 10 or 11%, but where your overall ROI is designed to be well over 25%. Bottom left corner, when you have a tenant there, they're actually paying the house down. These are usually new houses, they're newer houses, they're in the most desirable districts and areas in the country where people want to be. That's 4% of your ROI on average. Bottom right corner, appreciation, usually accounts for in these markets 15 to 30%. Some people are like, no way, the market doesn't go up 15 to 30%. With leverage, it does. And there's a way to even, believe it or not, there's a way to get leverage even if you buy with a self-directed account. We'll talk about that a little bit, probably in our Q&A. And then you do have the depreciation or the tax savings, which is 3% of the ROI. And if it's inside a self-directed account, you pick that up anyway. So I never touch a deal unless there's a 25% ROI, but generally I'm somewhere in the mid 30s. And that's where my money is doubling every other year. And all of a sudden it becomes very feasible to say, hey, if you're a planner and you're going to be at this for 10 to 20 years, now building a multi-million-dollar portfolio is something that becomes very realistic. Now, just for my numbers people out there, I'm just going to show you just a quick little strategy because some of you like this. And it's like, wow, what would happen if I actually bought one home every year for 5 years? You've got year 1, year 2, year 3, year 4, year 5, and I don't have time to go through a lot of this, so just screenshot it. But this is what I wanted to get to. What happens by year 10, 15, and 20? And just go to the far right and look at year 20. And on the far right in that blue box, those 5 homes, you'll have invested $425,000. Your annual cash flow that you keep, your take home is $147,000 a year. So your cash on cash ROI is around 34.6%. But if you come all the way down and take a look at the total purchase price, you paid $1.3 million for the homes, but over the 20-year, the portfolio is now valued at $3.7 million. So bottom line, real estate becomes really, really powerful. Now, I'm going to show you just a couple of markets to buy in, and then we can kind of break down how this all works. Is that?
Yeah, because that was Lola's question in the Q&A. Is like, what areas are you buying in?
Okay.
What are the markets? You're like, you're ahead of the game, Lola. We're hitting that.
Lola, I'm going to share with you 4 markets that are my favorites. And mind you that out of 324 markets, I'm looking at the macroeconomics. I pay for and buy a lot of data to share with you what I am right now. Central Florida is the first one I want to share with you. This was a pandemic-induced hyper boom in 2020. The first half of 2022 ended by increasing inflation and rising interest rates. 2023 expected to be a healthier market. We had huge supply chain issues here. So home prices still ended at 2022's almost 10% higher year over year, despite spiking interest rates. This is a high net immigration number market where a lot of people are moving in. Population is 5.2 million and it's growing at 7%. It's ranked number 3 in the nation for job growth. And right now, everyone is moving to Florida. You probably saw that last year we had 1 million people between California and New York move out. Where did they move? Florida and Texas. Florida was number 1. $7 billion of infrastructure going in, especially into the central area where you're a lot more, you're safe from hurricanes. They have a $20 billion surplus in their budget, 309,000 new jobs last year, 36 million tourists. The greater Orlando area had 102,000 new jobs. And unemployment is really, really low. So those are the macroeconomics that I look at in 320 markets plus before I actually select a market that I'm going to be in. And eyes on screen, wealthy Americans, they are flocking here at crazy rates. And I'll just share with you some of my Florida deals, right? This is an actual deal that I bought, and that one has a 30.62% ROI. I know that there's a million other numbers on the screen. We're going to cover those later in the document that I give you. Here's a second market, Lola and everybody else, Oklahoma City. This is not a growth market. This is what I call a cash flow market. Rental rates increased here 6.3% year over year in 2022. Appreciation is sitting at 5.4%. It's a very stable, steady market. And if we continue, here's one of my homes with a 29.81% annual ROI. Now, this is the number that I use. If this number is over 25%, I will buy the home every time. But you also find that I buy in markets where I control huge infrastructure. Here's another one, Northwest Arkansas. It's like, wow, Arkansas? Number 4 top real estate market in the country for 2023. 10,000 new jobs coming to the market from Tyson Foods, closing offices in Chicago and South Dakota. Tech jobs in that certain quadrant is increasing twice the national average. Home prices increased 27% in the first half of 2022. Builders are still super aggressive, and yet I'm getting really huge discounts in those areas. This is an example of one I'm buying there. You can see from the picture, this is a new build. It's 2023, 1,600 square feet. Like, guys, people get lost in so many numbers. The only number that matters is the one circled in red right there, 30.1%. Memphis, this is the 4th and final market that I'll share with you, I think, for tonight. Memphis metro home prices ended in 2022 at a net gain of 7% year over year. Shelby County year over year home values increased 13.7%. And it's like, Kris, how did you happen to be in a market that's hitting appreciation like this? This is the macroeconomics, the data studies that we're doing. And it takes me every 5 or 6 years, I'll move into a new market and I'll shut down an old market. And so we're basically tracking the entire nation, and we're basically saying, think about it. Where is everybody moving? Where is the job growth? Where is the prices of affordability still low? And you start taking a look at all 10 pieces of data that I'll give you in that document. All of a sudden it's like, oh my gosh, you feel like you have the crystal ball and you're like, I know where the next, imagine if you could go back in time 40 years and buy real estate in San Diego or New York or Seattle. Like, how crazy would that be? That's what we're doing here. We're basically saying we're identifying the next booming markets. And so a lot of people were like, well, real estate, isn't that just about going into my backyard and finding a good deal on a house? And I'm like, no, half your ROI comes from where you buy real estate, and it's never your backyard. Not for me, at least. Like, I live in Utah, and the last time I bought a house in Utah was 5 years ago for me. And before that, it was 10 years prior to that. So I don't even own real estate where I live. Why would I do that for a lower ROI? Now, some of you are thinking, okay, but Kris, out of state's got to be scary. There's a solution for that. We'll get to that.
Yeah, let me ask you this, Kris, because there's kind of a theme in those markets that you mentioned, like Arkansas, Central Florida, Oklahoma City, Memphis, Tennessee, low tax states.
Yeah.
Affordable housing still. Those homes are still affordable.
Well, remember, the national median is sitting right around $416,000. Like, this is a crazy number. People are like, it has to come down. The market has to come down. I'm like, you crazy. You're missing 6 million homes. The moment rates come down, I'm projecting that median home price is going to go up another $50,000 to $100,000 over the next 18 to 24 months.
What is a market you would say don't buy?
Everywhere else. Like where you live. Like, no, I mean, that sounds a little bit harsh and horrible, but like, what keeps me safe in this strategy is I don't buy $1 million homes. In 2008, what happened to a $1 million home? It became worth $500,000. What happened to the $500,000 home? Became worth $300,000. What happened to the $300,000 home? Became worth $220,000. What happened to the $220,000 house? Became worth $190,000. What happened to the $190,000? Well, it became worth $180,000. I was buying my houses for around $180,000. So guess what I experienced during 2008? Bloop, just almost nothing. Couldn't even feel it. What did that enable me to do? Well, guess what? A lot of people don't understand that when the real estate market does eventually crash, which, by the way, is a good thing. You can always spot it coming. It's a supply and demand issue. I love it so much. It's like, I can't wait for the next crash, but we're about a decade out. I can't wait. I'm preparing for it, but I know it has to happen between now and then. We have to see a really huge boom and a huge surge. So I'm buying as much as I can based on that. But you got to buy in the markets where you can have positive cash flow. Where you live, there's probably no positive cash flow. And that's because it's very difficult to get all of the macroeconomics and then the micro to line up to produce these really high ROIs. It's not like you can pluck something out of your backyard, Matt, and just say, oh, I also got a 25% ROI. Like, that's just very, very unlikely.
Let me ask Wendy's question here, because this will get back to, I think, where you're going to go. She's like, you have a team of people that help you find homes. I'm looking for homes to buy, but can't travel to all these places easily and get to know the areas and cities, where it'd be the best. How can us, the little guys, do this? Yeah,
so Wendy, first of all, I'm the little guy. Like, the college kid that started with nothing and now has done this thousands of times. When I got some advice from one of my business mentors that said, hey, Kris, you get paid according to the value that you create in the world. And so the question was asked, where can you create the most value? I said, well, what I do in real estate and single family is only provided by REITs. And based on the way they do their fee structures, they don't pass on a lot of the profits to you. So I said, I'm going to be the little guy that is going to figure out how to scale single family. And Grant Cardone and everyone said, you're crazy. You need to grow up and get into apartment complexes and you need to get to commercial. And I said, yeah, but I get that that's the easier move, but I have to go to a lower ROI to do that. Why would I do that? And so even today, why am I buying all the single family? Because I can't find an asset class in real estate that predictably produces the exact same type of ROI that I can predictably get every single time. So let me show you, Wendy, like how I do that for people. And also I hope you pick up some tips along the way of like, can you do this on your own? Because with my social media following, there's 8 to 10 million views on all of my social I get every week. And every day I meet someone in the world that says, Kris, if you have an excess of real estate, can I be your partner? And can you have your team of 200 experts just do this for me? And that is one of the services that I provide for some people. And for others, it's let me just show you how to do it on your own. So I'll do both right now. So eyes on the screen here, let me kind of show you a model that I created. I kind of suggested it with my father-in-law, but that was like a lot of partners ago. We bought 50 homes. He retired with millions of dollars. And he's been one of my great supporters. But I've grown up since then. And I have hundreds of partners around the country. And when we partner, we usually do a 50-50 partnership. On the right side, my partner that is bringing a 401k or IRA in the form of a self-directed fund, they want to get into real estate, they're my passive partner. And basically they're bringing some money and strategic decision making on buying and selling and how long we're going to be in a market. But on my side, I basically research the best markets, find the best deals, I manage the rehab, I lease the property manage, do the accounting, the taxes, I sell the home, I multiply the portfolio. There's 342 hours of work that goes into each acquisition just to get the home set in place. Most people cut corners and that's why their ROI goes down. I feel very blessed to have a team of 200 experts that does all this for me. And so bottom line is when you sell, you get your money back first. We basically just split profits. But the reality is that most want to just grow their portfolio and compound it over and over and over and over again. And we'll talk about why in just a moment. By the way, I still do it today. I actually have... every month I open up a certain number of slots for new partners to come into my world. And while I'm very limited, I can't take everybody on. I always make some room for some new partners on a monthly basis. And so my team, they're finding excess. They're finding more real estate, really good deals that I can't buy. And that's when I choose to let a new partner in. So I'll kind of break down a little bit what this looks like. But I have a goal of becoming a billionaire through real estate. I also have a goal of becoming a multi-billionaire through private equity. On the real estate front, most of the social media world knows me for the real estate game that I've been playing for the last 20 years. I can't tell you how much money I have lost by not doing deals that were available to me, and that's when I started partnering. So that's really kind of something that makes me unique and different. Now, there's 7 steps for you that whether you want to do it yourself or you want to do it with me, there's 7 steps to investing in finding this kind of stuff, and that starts with that document I'm going to give you here in a moment. But here's my 7 steps when I partner with someone. You need a team. So I'm going to introduce you to my team if we're working together. And then I'm going to talk about the best path to purchase property because there's options. Then we review your game plan. Then we get under contract. We either are setting up an LLC based on how we're buying or it's being syndicated through one of my funds. We then purchase the property and then we manage it. And then if there's funds, we just do it again. So I'll go through these 7 steps a little slower. So meeting me and the team. When someone partners with me, they get access to my personal cell phone. And they get added to a text thread with me and the key members of my team. I'm not going to introduce you to 200 people, but there's a couple of account managers, if you will, that you'll connect with and me. And basically, we're going to build this portfolio. Basically, you're going to spend a few hours on your first property. And then after that, it's probably less than an hour per property acquisition after. So this is afterwards it's 10 minutes a month for you to just read your report and just see how we did. And then, of course, we're just connecting and texting anytime you have questions. Second step is all about finding the best path to purchase. So that could be, do I want to use banks? Do I want to use my partner fund? When someone has, for example, money in a 401k or IRA, I always say you can pay taxes and penalties and flush maybe 20, 30, 40% of that away or more. Instead, self-direct it. You guys know that directed IRA is my go-to partner. So they're the ones exclusively for all of my clients that will then direct that to avoid the tax and penalty. And we explore ways of putting that in the game of real estate. And I'm sure at the end we'll do some Q&A on some different ways, Matt, that can be done. And what's great about the syndication fund is you don't have to qualify with banks and come up with paperwork and pay stubs. But I have a handful of partners that actually love that. And so that's kind of their path to how they like to get into real estate. It's really up to you. The ROIs are going to be the same. The third step is then reviewing a game plan. And it's number one, we're only going to go into the top markets. We're never going to look at a deal less than 25% ROI. We're going to rent the home generally for about 5 years, and then we're going to trade up 1 for 2 or 1 for 3 or 1 for 4 homes. And if we trade that, if we end up starting, for example, with a property and double it, that 25% ROI is no longer 25. They're now earning 50% on that original dollar. By the time you get to year 10, you've doubled your portfolio again if you're going that slow, and now you're getting 100% on your money. It looks a little like this. This is the math that some people, Matt, don't understand. If I put money, call it 50 grand, into a single home producing me 25%, if I can sell that home and trade it for 2 more, that original dollar plus my profits, I'm now earning 50% on my money. If 5 years later I double that again, 50% becomes 100%. If we do this over 20 years, you're now earning 400% a year on your money. And this is where the light bulb should go on saying, oh, that's why people make millions in real estate. They're never paying taxes. The cash flow is tax-free, depending on the strategy that you're using. And then we're basically just multiplying that ROI by compounding it. So when Albert Einstein said that compound interest is the greatest financial invention of all time, I call him a liar. If it's in a 401k and it's single digit, it's not that fantastic. But if you can then graduate to double digit, like 25% or more, well, now we're talking. Now your working life, it's realistic. Instead of retiring with 200 or 300 grand, to retire with several $1 million. And really that's all real estate does, is it says, oh, like forget real estate, forget strategy. Don't listen to that. Listen to this message. You need to find a way to get to a higher ROI with calculated risk and diversification to get your retirement goal. And it'll never happen with the way we amass money in single digits.
Yeah, and this is why I love real estate inside an IRA or 401k and outside of it. And we know with a self-directed IRA, I can still own real estate and get that appreciation value, that higher ROI that I'm not going to see in a typical mutual fund or ETF or in the S&P 500. And so when Kris is like saying this single digit return in your IRA or 401k, that's you that are still on Wall Street, right? And so we want to be looking at real estate even in the IRA. And there's hundreds of people listening now that already have this. You guys know this is what I do with my own retirement account. But I mean, I was frustrated, and that's what drew me to self-directing to begin with to myself, is I want to do this for my own account. Like I became an expert in the tax rules as tax lawyer, Matt, to learn how to do it for my clients. And then I need to do this for myself first and foremost, you know? And so I think for anyone that has your IRA or 401k dollars, you have an account at directed IRA, you've been interested in real estate, I just want to take a second and take a step back. Real estate investing is not in your IRA or 401k or out. You don't have to pick one or the other. It's not like do it in your IRA, do it personally. I'm saying do it both. Do it both. If the ROI is higher, what do you care what it's coming from? Now, Wall Street's telling you, well, you need to be diversified. Why? I just want a higher ROI at the end of the day because I want the largest retirement account I can rely on, so I have a retirement I'm looking forward to. And so I love that you're focusing down at the end of the day on ROI, Kris, but tell me, like, I know we've talked about, buying personally, right? You've talked about there are some tax benefits to that. I can tell you there's, paying no tax when you're buying and selling properties in your retirement account. Many of you guys know that. And the Roth accounts are going to come out totally tax-free at retirement. But what do you think gets people stuck to where they're not buying real estate? Like, why is that opportunity still there and the higher ROI still there?
It's interesting. When I was a college kid, I actually sold, if you know the name Donald Trump, he used to have a real estate program like Robert Kiyosaki had a real estate program like Dolph DeRoos and Robert Allen. These were the
Trump
real estate
University?
gurus. Yes, Trump University.
Yeah.
And what these guys did is they basically sold these $10,000, $20,000, $30,000 training programs and said, we're going to train you how to do this on your own. And the majority of people back then were like, it's better to teach a man to fish than give him a fish. So teach me how to do it. If you look at what's happened in the last 20 years, 80, 90% of the people, that's my guess, they don't want to be shown how to fish anymore. They just want to be given a fish. Because listen, life has gotten crazy. Our dollar's been so devalued. If you take a look at real estate that has gone up, 13x, in price, and salaries have only gone up 7x, we are not keeping up, which means people have to work harder. They have to get more side jobs. They have to have dual income earning families. And even financially, that's not enough. So the idea of, hey, I want a side project to invest in real estate is a huge turnoff. What people are looking for today is more of a passive done-for-you option. Normally, there's only the REIT option, but Matt, that really ends up through fee structures really eroding a lot of the money that's available. We're doing something definitely different and unique here. And so I think you have two options. The first one is go out there and learn how to invest. And I'll give you that document at the end that will show you step by step how I do it. And there might be some of you here that are like, hey, Kris, if you have some spots open and you'll just do it all for me and we can split it, but we're both better off than having done it on my own, that also appeals to a certain demographic as well. And so there's something available there.
All right. Do you mind if we hit a few questions right now? We'll take a little intermission on questions.
Yeah.
We'll do some Q&A at the end, but there are so many questions here. I'm right on point to some of the things you just talked about. Benny asked, because you kind of glossed over, you mentioned multifamily. You're like the Grant Cardones of the world. You know,
Yeah.
they're like, just you got to do multifamily. You got to go big. Benny asked, what about multifamily instead of single family?
Yes.
Is multifamily better than buying all these single family homes?
Benny, it's a really, really great question. I wrote a book this last year called Have It All, and it talks about the 5 ROIs that will change your life. And everyone's always looking for a strategy, Benny, just like your question. You're like, oh, but what about multifamily? Or what about commercial? Or I've heard things about this strategy. Or maybe I should do some of that. And instead, I actually don't always look at the strategy. I look at a different vector. For me, I actually look at ROI and diversifying ROI, not just strategy. Which means, like, I can tell you this last year, my net worth increased 9 figures. And I've had a goal for the last 14 years of being a billionaire. And I now have a very short range projection of when I believe that's not going to happen. How did that happen? It happened from diversifying my ROIs. So some of my money is in real estate earning double digits. Some of my money is in businesses earning triple digits. Some are earning quadruple digits. I have some things that actually earn me an infinite ROI. And so one of the things that you learn is that the higher the ROI, most people think the higher the risk, but the reality is that's not always necessarily true. For example, when you say, well, Kris, what about multifamily or fourplexes? For me, the decision is really simple. What will produce the highest ROI? Not what strategy sounds cooler. And I'm going to tell you right now that if you were to compare 10 fourplexes out there, go find 10 amazing fourplexes and compare them to my single families, and here will be my question. Can you earn 25% year over year on it? That's my minimum. Can you beat my average of 34%? And you know what? If you, not one off, but if you can consistently do that, then I would say do that. I haven't found multifamily that can do that. I haven't found apartment complexes that can do that. I haven't found commercial that can do that. So guess where I'm at? I'm where the ROI is. Now notice that you can find a random deal and like, Kris, I found a deal, I'm getting 50% ROI. But now you're stepping into a different set of dangerous waters. You have an example of one. Is it duplicatable? And if it's not duplicatable, I won't touch it. Because my world is based on iteration of systems, which means, can I homogeneously produce the same result over and over and over again? I can do that in single family. I cannot do that in multifamily. And so for me, the efficacy of the system is more important than the one-off result of a single deal. Because if I can't duplicate it, then I'm actually taking on unnecessary risks. Because if I do something and it works, I need to be able to do it again. And in single family, I can produce a result of ROI higher than I can anywhere else. I hope that makes sense.
Okay, love it. Do you want to take any other questions, Aaron?
Yeah, take a couple.
Okay, we got Aaron over there. He's got a mic. I hope you guys can hear him.
Okay, so one of the biggest questions we keep getting is how exactly can I buy a single family home with my IRA or a solo 401k?
So actually, I'll when we get out of Q&A mode, I'll actually demonstrate that next because I'm on step 3 of the 7, and in a few more minutes I'll get through all 7, and then I think that's going to create really great clarity on how does the self-directed portion of this actually work to make that happen. But I would also add that I have people that are leveraging, home equity, and even in this market with these interest rates, a lot of people are very rate conscious, and you shouldn't be. Meaning, in the investment world, you don't want to think like a consumer. Like, for example, if I buy a home with an interest rate at 7% versus 8%, or 7% versus 6%, to you, you've been trained to think that that's a nightmare of a difference. In the ROI, it makes less than a 1% difference in the overall ROI. So it's actually not a really big deal because that's only representing a very small portion of the profits because cash flow is a very small part of the overall growth strategy of how this works. Which means I have some people that are pulling, for example, equity out of their homes because they've run out of self-directed ROIs or they don't have them. And that's just another funding source to say, oh, are you telling me that I can pull equity out of my house to buy an investment property and have the cash flow from the investment property pay back my equity line? And the answer is yes. Those examples exist too.
So I know, Kris, we're going to hit on here in a little bit about each of these different ways of like active versus passive investor.
Yeah.
So everybody hang tight on that because we got a ton of those questions.
Yeah.
But tell everyone, and just maybe repeat it for them, your top 3 areas that you love for real estate right now. They're just dying to hear that.
So honestly, Florida is my number 1 growth market, and then Tennessee and Arkansas specifically, that's where I consistently pull my higher cash flows. Growth might go down a little bit, cash flow compensates. Our overall ROI is roughly the same though. Great question.
All right, well, we'll come back to Q&A because Kris, I think he's going to cover a lot of these questions, and then Aaron and I are going to be able to play cleanup on what he didn't hit, and then we'll hit a final Q&A. Sound good, Kris?
Perfect. All right, so this is what I want to just bring everyone's attention back to, is in red at the very bottom, that's what a 401k looks like. That's your brain on drugs. This reminds me of that ad campaign. Green is what happens when your same 50K is earning at 25%, but if you go to 34%, you start picking up that crazy exponential increase. And really, that's the whole point here. It's like when Benny's like, well, why not multifamily? I'm like, show me a deal consistently that you can do that actually produces a higher ROI. And if you can't, it's going to be more boring. It's going to be less interesting to me. All right, here's the 4th step. Once we have a game plan and we've got our funding strategy in place, it's now time to get under contract with the right kind of homes. And I've shared with you that we've got 5 markets out of the top 324 in the nation. We're basically going to the places where population migration, business affordability, median price meet certain criteria. And here's another one. You've heard of real estate owners with bad tenants. Check this rule out. My average renter makes $60,000 a year. That is a must for me in this game because these people, this is going to sound rude, these people don't trash your homes, but people that make less than that traditionally do. So all of this actually adds up into the overall ROI. Now here's an example of a home, for example. If you look in that red box on the left, this is a property in Florida. This is a 35.5% annual ROI. And that's hot, like that's amazing. Here's another one. This is also in Winter Haven at 31%. And this document at the very end is what I will give you because this is everything I learned from the Great Recession. This is everything I learned from buying my first several thousand homes out of state and why I will never buy in my own state ever again. And this will give you the step-by-step system. All right, so in getting under contract, here's a couple of things that are important to me that most people aren't aware of. Number 1, when I buy in groups with all my partners, I'm able to actually get bulk discount and lower my fees. Down payments and repair fees and research, bird dogs, all of these different people, they cost money. And because I do everything in bulk, a team of 200 on my team basically lowers all these fees, and it really lowers things substantially. So that's one of the things that I love about real estate that also bumps up my ROI. My 5th step is we now have a property under contract, and if we've bought inside generally, and this is going to answer that question, if we're buying inside a self-directed account, then once you buy that property, you don't need to put an LLC together, you don't need to set up a bank account. You've made your investment inside that, and that's now money in a fund that is actually spread over a bunch of different properties. So you've actually mitigated a ton of risk, and it's a very, very passive approach to getting some really amazing, meaningful, huge gains in real estate. But occasionally, once in a while, I have partners that will say, no, we're going to go through the bank and we want to qualify and we want to use their credit. So then we will set up an LLC, an operating agreement. We'll set up their bank account. And we generally fund $10,000 in the Sleep Well at Night account for some peace of mind for the new investor, $5,000 for every deal after, and that seems to be enough to keep the accounts where it needs to be. Okay, 2 more steps. Step 6, it's time to buy the property. And that generally takes 30 to 40 days to get closed. We're going to send a notary to you to sign on the property. You're going to wire money from the account. That property will then be deeded into the LLC, or then you have your fund, and then you prepare for your next purchase. The 7th and final step is my team oversees third-party property managers. Here's one of my favorite hacks. If you've ever worried about, shoot, if I bought an out-of-state property and I had a property manager that was charging me 10%, that's like $120 or $180 a month to them. Could I really be meaningful to them? And if you want to know the truth, no matter what they tell you, you mean nothing to them because they hopefully have hundreds of homes, maybe more, and you're just one. And you're not a big client, you're a tiny client. When I go, I find a medium-sized property management company that's usually managing about 1,000 homes, and then within a couple of years, I'll give them 500 homes. And when I do that, they have a very meaningful client. And they don't charge me 10%. They'll charge me 6 to 8%. And I'm the one that they're going to take care of because if they mess up, I take the entire portfolio and walk away. So there is something to say for bulk real estate. Even those homes are often individually owned by my partners, they kind of treat me like I'm the partner. Okay. So then I've got a full-fledged CFO team that steps in. We do all of the monthly financials and basically make sure we get good tenants in, and then it's time to rinse and repeat. At this point, guys, if I'm just being leveling with you, I am bored out of my mind. The reason why I got into the private equity game is because real estate has not taught me anything for a decade. It is a machine that just prints money for me, and I love that. It is predictable. I've done it thousands of times for thousands of people, and it's just a powerful system at this point. And I like that there's nothing new to learn because it just means that it's just pure predictability. I'll just kind of end with this before we go into some Q&A. I've got some great partners, hundreds of them. This is Jim. He and I think we own, this is when he had bought 4 houses. He's up to 7 houses right now. Jim's a doctor, and he's a classic example of someone that just says, Kris, I'm focusing on my practice. He's also working with me on some humanitarian work. He's done something in my foundation. He's a very, very cool guy, but he doesn't want to be a real estate investor. That's just too much work if he's active. This is Kim. She discovered me back in 2011, followed me for some social media, then finally got down to it and bought 3 properties with me. And honestly, there's a lot of other people, people that we can flag. And I've got all my Google reviews online, and I've got my own reputation that is all driven by social media. So we got to keep it really good. So here's we kind of get down to the bottom of it. How can you use a self-directed IRA to invest in real estate? Well, there's 3 major options I want to share with you. When your money is in a self-directed IRA, you can either use it to buy real estate free and clear. You can get certain type of loans, that you can use to buy inside of that. Or you could pull your money out and pay taxes and buy real estate that way, but I do not recommend that one. And so generally it's, well, if my money is self-directed, then I'm going to buy into a fund. And if I don't want to buy into a fund, then there are these other types of loans that you can access that can still help you buy real estate. So there's options for how you can do that. My choice. You can use it to buy real estate free and clear, but honestly, I love to put it into qualified real estate funds. And this is a big one. You can do that one and often get your money in for as little as $50,000, although some people put in quite a bit more. And I always look at $50,000 as the equivalent of a down payment on a home. So someone puts in $150,000 on the math I've been showing you tonight. That's like starting with 3 homes and at 25% ROI, hopefully based on that math for illustrative purposes, winding up at around $13 million. And so those $50,000 increments, I think, are important in creating some level of future predictability. All right, so if you want to learn some more, I promised that I would give you this before we go into some Q&A.
Yeah.
And if you go to kriskrohn.com/more, let me give you this track record. Just drop your information in there. And I'm also going to make sure that my team reaches out to you with a follow-up custom real estate game plan. So it's kind of a twofer. It's like, get the document, and my team will text you today. And they'll just say, hey, if you want to chat about a custom game plan, I think this is important. I think where I've created a name for myself is in what I call a custom game plan. And here's what it means. You might be watching here saying, oh, Kris, I own a business, and because of my tax structure, it doesn't look like I have a whole lot of money because I write so much off. What would you do? Hey, Kris, I have this much in a self-directed IRA. How much would you put into real estate, and what would happen, or what are my options? And I find that usually everyone kind of wants a little bit of a personal touch of, well, Kris, if you've done this so successfully, what would you do? And so I'll have a team that'll reach out to you. They'll get you this document, and then more importantly, also just say, hey, and if you want to get a custom game plan and just see what Kris would do, or also just explore if he has room for partnership with you, they can take you through that process. This is a different QR code, a way for grabbing it. If it's not kriskrohn.com/more, I'm sure the team's dropping that link in the chat, or you can just go ahead and whip out your phone, and that would be another way of accessing that same document. And then I'll turn this one back over to you, Aaron. This is about everyone here. If you're not self-directed, you can schedule your own free 15-minute new account call with directed IRA specialists. They've got a special discount for you, and if you use the promo code KrohnWebinar100, that's how you'll get that additional discount. And so, yeah, either way, be self-directed. Why? Because then you're prepared. Then you're ready to strike, and I think that's really important. All right, with that, I think we're gonna move into some Q&A here, and Aaron.
Whoa!
Coming on screen.
Okay, here we go. All right, should we do some rapid fire? Matt, you got one?
Yeah, let's do some
Start us
rapid
off.
fire. I might field some of these too, because we got some
Okay.
technical self-directed questions.
Here,
So
this is a good one.
Yeah,
Let's
all right,
start
fire
with
away.
Carrie. She says, if I have a self-directed IRA with enough capital, is it better to pay cash for the property or do it with a down payment and finance? Of course, we'd have to get into non-recourse on that too. But let's cover that.
Matt, we've been talking about non-recourse a little bit. Why don't you actually jump into that as the specialist here?
Love that.
Yeah, I mean, I would get a non-recourse loan. So if you have, let's say you have 300 grand in your IRA, and you could buy one property for 300,000, or you could buy, for that cash, 100% cash, or you could buy 3 properties by putting 100,000 down and have 900,000 of real estate. What would you rather do?
Oh, please pick 3.
Yeah.
Please say that 3 is better than 1. The bigger number wins in the game of real estate. You don't want less.
Exactly.
By the way, I got to say, Matt, I get this question from people because they're like, oh, I have 2 properties, but they're paid off. And I'm like, I'd rather have 10 properties.
Right, yeah. I mean, and think of that too. I want to think about it for you real estate investors, because I think about this too. I look at my own portfolio and I think, where do I have equity? Even if I could sell a property and get equity out or strip equity out to go buy more assets to grow it. So it's the same thing when we're looking at using a non-recourse loan. Now, when buying real estate, and there's been a couple other questions on this, you can get a loan to acquire the property. It just has to be what's called a non-recourse loan. Basically, that means you can't guarantee the debt. In the event of foreclosure, they can't go after you or the IRA. The bank can basically foreclose and take the property back. Now, there's a catch on a non-recourse loan. You're going to put 30 to 40% down. Okay, this is not 10, 20% down. So my example there, if it might take you 100 grand to get a $300,000 property, is pretty close in line of how aggressive you could get in terms of a non-recourse loan. 100,000 down to get a 300,000 property. The bank would finance the other 200 grand.
Yep, and there is another option. So when someone does partner with me, I inevitably always have partners, and I like for them to have options. More options is more good.
Yeah.
So people will either say, hey, Kris, I've got this money. Can I buy homes individually with you and qualify for them individually? And I'm like, sure. And then they'll say, yeah, but what if my money's self-directed? Can I buy into your fund and have that same 300,000 feel like it's spread over 6 properties so that I get a lot more diversification and I start picking up a higher ROI? And I say, sure. The truth is I don't care, because both my fund and buying individually are rigged to have the same awesome ROI. And that's because I want you to focus on what matters more, which is ROI, not vehicle. Do the vehicle that makes the most sense. I would say in the majority of situations, you'd be hard-pressed to find a situation where you'd ever want to pull money out to pay taxes and penalties when you can just do that through a self-directed account.
Matt, let's hit on the conversion of traditional to Roth and when, buying real estate, because we haven't really hit on the power of the Roth baby.
Yeah, so for any of you that have a traditional IRA or traditional 401k, remember, as you're growing and building wealth, this is taxed later. Like the government's coming around at some point and they're going to tax you later. They call it tax deferred. But as you start pulling money out of retirement, you're going to pay taxes. You're pulling the money out after 59 and a half. But in the Roth account, the awesome thing about the Roth and why we have more Roth accounts than the other accounts at Directed IRA is our team here knows, our clients know, as you're growing and building that account, it's taxed never. When you start pulling out a retirement account, it's taxed never.
Can you say that again?
Yeah.
For a guy like me that has like all sorts of elaborate systems and setups for reducing my taxes, I like tax never.
Yeah, tax never is pretty sweet. So that's the Roth. Now, if you're going to buy real estate, we always recommend converting before buying real estate. That's the best because we can just convert the cash. So you can get from a traditional to a Roth. It's called a Roth conversion. But you got to get a value of that. If you're in cash, it's easier. If you've already bought real estate in a traditional, we can still convert it to Roth, but we got to get an appraisal of the property. So it's just a little bit more work, but you can still get over to the Roth party. Or as Aaron says, Roth baby.
Roth and roll. All right, so we did get this question, was pretty redundant. I'm going to hit on it real quick. So if you're using a self-directed IRA for these down payments and trying to get this non-recourse loan, how hard is it actually to do that? So there's about a dozen banks, and we have that on our website. If you go to directedira.com, we have a professional resource directory. It's awesome. We list a handful of them there and the direct contact info. And that's what they do, everyone. They do non-recourse loans. We're seeing them right now between 7 and 9%. Like Matt said, they're going up to about 70% LTV. So you're going to come in with 30% with your IRA, but you're going to have an additional 10 to 20% in cash reserves. And they want that to cover any like vacancy, future maintenance, property management, just additional expenses there. So that's kind of what you're looking at. The benefit to do that, if you do go that route, is you don't have like a private money partner or anything.
Yeah.
However, you do have the other options like we talked about today. You can come in, maybe do the whole thing with your IRA. You can partner with other people. We love that strategy as well. Or if you just want to be completely passive, like we heard about, you can go into these different syndication funds. Kris has different funds that they have, which you're welcome to look at that and check all that out and meet with his team. So there's lots of options to do it passively as well.
All right, Kris, and I got a question. This is from Elise. There's a couple other questions on insurance, particularly when you're bringing up Florida. Someone's asking about, do you have any issues getting property insurance in Florida? Elise asked, can Kris provide his insight regarding property insurance? And then she also asked, what was Kris's major at the university? You said undecided.
Thank you. Thank you. I did actually graduate, but that was so that my mother-in-law would not kill me.
You got to have some respect for the mother-in-law.
There was a ton of pressure to get a degree, and in the end I got a degree in family science. And which, by the way, with 4 kids has come greatly in hand, but hasn't done a lot for my entrepreneurship career, right?
Yeah, you didn't need it. You're good.
So Elise, right, the question was on
property insurance.
Property insurance.
And also an earlier question about Florida in particular.
Yeah,
for property
so
insurance.
in Florida, unfortunately, we're not able to get any insurance ever, so we're just always at risk for storms. I'm just joking.
Or is that honestly what you said?
No. So
you did say Central Florida.
So Central does actually provide quite a bit more protection, but no, all of the properties are insured. And no, we don't have a problem getting insurance on the properties. That's a cost of business, and it's something that we just take into account, and we got to make sure that we have really great insurance.
And that's all in your numbers. That cost of insurance, that's all an expense in your numbers.
Yeah, so
anytime
I put up one of those performas, one of the things that you'll see, even though we didn't talk about all the assumptions, because I have actuaries on having done this thousands of times, we actually look at what actual vacancies are, what actual repairs are, what insurance costs are. And so what we do is every year we actually republish our numbers for the previous year, and we usually end up beating them with accuracy around 98%. And we end up being more conservative than in actuality. Also, the ROIs that we show you according to our historicals, we usually end up outperforming that by about 20% because we intentionally keep all of our numbers down about 20%. By the way, I did see the comma there, Josh. For those of you that didn't grab that document yet, we'll put that up real quick here.
There we go.
KrisKrohn.com/more will get you the entire breakdown of my system, how it works, how you can do it on your own, or connect with my team. And if I've got room for partnering, explore that. See if it's a fit for you. And for those of you that have been watching me on social media for years, I'm just glad to reconnect with you deeper. And if we've never met before, go to whatever you follow on social media and just type in my weird spelling name, Kris Krohn, and I'll pop up and we'll get to know each other better.
Yeah, I mean, this is a question, like Lindsay asked, can I become a passive partner? Mm-hmm. How? Steve asked, how do I sign up with Kris?
That's how. Go there to start.
All these questions. Louis, how do I get an email with Kris? Like this is the process.
So once you download that document, my team will likely call you and probably text you. And so if someone texts you and says, hi, my name is Cody, I'm calling on behalf of Kris Krohn. I saw that you got the document. If you want to find some time to connect on partnering, they'll give you those details. What I can tell you is that when people partner with me, for the millions of dollars that we're going to make in the business, it's a very inexpensive business to start. Getting all the tools and resources put together, most people will have some type of upfront investment, of $10,000 to $35,000, and then for the duration of the entire business, that actually covers everything so they can build a multi-million-dollar portfolio. So it's actually a really great business to get into, and it's very inexpensive, if you will, to basically acquire, the most honed team out there for just taking you to the top of the game where you're no longer in the learning curve mode and you're just winning.
One of the things we get asked at Directed IRA all the time is, how do I learn more? We always say, hey, invest in what you know. A lot of people know real estate.
Yeah.
Okay. This is no different here. This is just what you're doing. You're using a retirement account, though. But when you work with other people and you go do deals with other companies, you're learning the systems, tools, processes, the team, what it takes to be a great operational partner, and all these things. So it's like, you're getting a lot of different insight, a different angle to it, and it's a great experience for you to learn as well. I want to hit on Captain Glenn's. We got Captain Glenn. Thank you, Glenn.
Captain Glenn. I like the compliment. I'm going to go by Captain Kris.
I love that.
That's great.
Love that. So he wants to know what fees are involved when you use a self-directed IRA to purchase real estate. And we get this a lot, like, if I have 100,000 or if I have 10 million, are you charging based on my account growth? Well, that'd be like us penalizing you. So we don't want to do that. We want your account to grow. So our fee structure is super simple and clean. We just charge a flat annual fee of $395. That's it. And when you actually go to do an investment, it's a one-time $50 fee. That's it. There's no other hidden fees. It's super simple.
Can I actually just say when I met Mark and he was telling me about directed IRA, I was pretty blown away. I was like, that's not the fee structure that most have out there. That's not really the way most of the world works. And I was like, okay, this is a company I definitely need to get to know, and I want to have my accounts with them.
And that goes the same, like whether you do one investment deal or 20 investment deals, again, it's just $50. We're not charging you annually for each, kind of investment you do as well. We want you to grow. We want you to invest in what you know. We want you to grow that account and be successful at that. And we just, we want to deliver a great service and process that investment quick for you. That's where you can go read all of our 500 plus 5-star Google reviews.
All right, let me hit a few fire round questions.
Go for it.
I'm in the Q&A, Aaron. I don't know if you're in the chat.
I am.
Okay.
Yeah, I got them all.
Okay, you're in
Yep.
both. You're popping in both. Okay.
Yep.
So, oh, dang it just bumped.
Which one did you want?
Let me see. Okay, so I had a great lineup of questions. I'm sorry. This is like right when the moment it comes to me, I get bumped here.
Let me see if I got it.
Okay, someone asked, do you have to be an accredited investor for your fund?
Yeah, you don't actually have to be accredited. I've got room for both accredited and non-accredited people. I usually kick up a new fund every 90 days.
Love that.
Just to make sure I can service all of my partners in the real estate that we're doing together.
All right, cool. Then Bruce said, are we 50-50 on cash flow and sell of profits if we invest with you? How's the partnership thing work?
Yeah, so all the profits, when they get combined together, that's what we're going to be 50-50 on. And I would say that 95% of my partners, they're not looking to do a deal and say, hey, wow, we bought a property, it has cash flow, let's split the profits. In the majority of situations, what they're saying is, hey, my 401k or IRA was set aside to build retirement. This is now the way I'm doing it. So you know what? Let's just keep rolling profits forward. Let's just keep doing that. So the reason why they're doing that is, let's just say that theoretically we're earning 30% on our first deal. And let's just say that 4 years later, we sell that home and we are able to then direct all of the profits and the original down payment into 3 more homes, all at 30%. Well, 30 plus 30 plus 30 is now 90%. So your original investment is now earning 90% a year. That means that it is basically doubling every single year or 13 months. And then a few years later, you sell it, and if you buy 4 more, you're now sitting at 7 properties. You may be now, earning over 200% a year on your money that was originally earning 30%. So the longer you keep it in, the more compounding you get. And let me tell you something. When you interrupt compounding that is single digit, it just doesn't hurt.
Yeah.
But when you interrupt compounding at 25 or 35%, you don't want to touch that, because it's very difficult to produce those kind of gains anywhere else. Of course, my partners do have the discretion that if something happens and they need to liquidate or get out, I'm a great partner. I have so many homes, why should I complain? I'll go with where their needs are at. But those that are smart, and the majority of my partners, they just let it roll, let it roll, let it roll. And often it's because there's a legacy component. They want to leave a mark in society. It's not just for their own retirement. They're thinking about their children. They're thinking about their posterity. They're thinking about charity. They're thinking, well, maybe I need X millions for me for the kind of retirement that I want. But if I had more than that, well, then it would be really cool to spend some of my retirement years doing some other things, noteworthy things that, better society or provide opportunities for my family. And that's the kind of stuff that this can do for you. I've got 2 buddies whose previous parents, their parents invested in real estate, and now they are in the second generation, and one's a billionaire family, and the other one is a $500 million family. And so if you give real estate enough years, anyone can become a billionaire. Even if all you do is just buy one home, but stay in it. So usually people want to buy and then stay in it and just don't interrupt that compounding effect, so that it can really, because remember, every year at some point, it becomes astronomically big.
Okay, if you wanted to get that discount for directed IRA, people keep asking for that. We love discounts. We love $100 off, don't we?
It's right there.
You just enter in Krohn Webinar 100. You'll go to directedira.com. /appointment. You can schedule a call with one of our several self-directed IRA specialists. They're great at what they do. It's a free 15-minute call, getting started to open the account, get the money into the account, get it invested. So just use promo code Krohn100, webinar 100. We'll get you going. Now,
right.
Matt, we did get the IRA LLC. Did you see that one?
Nope. Yeah, if I hit that one, I'll answer it if you don't mind.
So the IRA LLC, that is a specific structure using a retirement account where the IRA is a member of the LLC. And that's an awesome strategy where you have what's called checkbook control. Rather than going through the custodian, you have the IRA is putting money into the business checking account of the LLC, and then you have checkbook control. You can do an earnest money deposit, you can invest in a private fund, you can invest in passively or actively into that fund, or do your own real estate deals. It's awesome. So it's called a single member IRA LLC. Now, we had other questions of people are like, hey, I want to use my personal funds. I want to use like a solo 401k I have. I want to do something with my son, daughter, my spouse, or whatever.
Yep.
You would do that through a specific structure called the multi-member IRA LLC. And we're happy to go over that. Just schedule a call with us. We'll go over the structure and strategy for that. Or if you're a small business owner and you want to do what's called a solo 401k, you can do that structure as well. We'd be happy to assist with any of that. Okay, Matt,
right.
What do you got?
Now, let me hit Captain Glenn. Sorry, he just has a couple of good questions.
Okay, all right, Captain Glenn.
Then
See when you have a strong name?
I'm going to rapid fire a few questions.
Do it.
If you guys don't mind.
Go for it.
Forgive me here, but Captain Glenn asks, I got $600K in an IRA. Do you recommend rolling half to a self-directed IRA or all to benefit with real estate? Well, Glenn, I guess my question to you would be, what's the return on investment? What's that you can get on that $600K? And if you can get a higher return on investment by investing it all in real estate, then I would do that. And so you want to analyze what's the opportunity of where that money is going to be if it's not in a real estate deal. And there's good real estate deals and bad real estate deals, whether you're using Kris or you're doing it on your own or whatever, or using someone else. I mean, you've got to analyze the deals and, of course, make your own investment decision. But I would chase the whole thing, but you could do partial. And for some people that are brand new to self-directing, you have a larger account, maybe just buy one deal first and see how it goes. And kind of work with, if you're working with someone, and see how they're doing. What's the track record? How's it going? Before you pile into the others. I get that. That could be a little more measured approach to it. And I don't know if you had a comment on that, Kris. But
I have a thought there for sure.
Okay, yeah. Why don't you help?
Yeah. So for Captain Glenn, when you get to a situation where it's like, okay, so we're not talking about $100,000 or $200,000. We're talking about a larger amount of money. One of the things that happens if someone does partner with me is I put on partner events every year. And I have a weekly mastermind with all of my partners, and it's live. And one of my goals is to educate all of my partners on all the things that are out there. Because real estate, think of it like a foundation. It's enough to build the retirement that you want 20 years from now. But when you say to yourself, what if I want to go faster? Like, what if I want a 10-year game plan? What if I want a 5-year game plan? Kris, what if I want a 2-year game plan? Well, there are other things to look at as well. And so I talk to my partners about private equity. I talk to them about franchises. I talk to them about all sorts of other business structures. And that's why I own hundreds of businesses, is because real estate is my foundation of wealth. But there's things to do beyond that. And self-directed IRAs are good for a lot of the other things as well. So just know that if we end up partnering with each other, my personal advice is going to be, don't go all in. I would go partial, and then I would probably buy yourself a few months or 6 months, come to one of my events, read a couple of my books. I'm going to talk about strategies to diversify into some other games and things as well. And, that's the way I would probably personally be looking at it.
All right, now Josh asked, I've been hearing about subject to, where you get the deed, but the mortgage stays in the seller's name. Pace Morby's the most vocal about this. Yes, that's totally legit. You can do it, by the way, guys.
Yes.
And you could just use $5,000 from your self-directed IRA and buy a house subject to. That could be a Roth IRA.
Yep.
Absolutely, Josh, totally feasible. We love Pace. You guys have seen them on our stuff before, too. And that is maybe for some of you that have smaller dollars and you want to use some creative finance strategies, that is a way to do it too. But that's the active investor. Okay, so like Josh, you're gonna have to go find those deals, source those deals, totally possible, but absolutely legit structure you can do subject to. Just don't personally guarantee that.
Yeah.
So if you're doing a seller deal, you're doing this creative finance strategy, don't personally guarantee it, that will blow it. I'd recommend using the IRA LLC, have the LLC be the borrower on the note with the seller. That'll be the cleanest, best way to do it.
And there's a lot of subject to. The majority of them don't take any money down as well. Pace is a really good friend of mine, and I've done thousands of flips, and I'll tell you that in that particular game, there's no reason to put money down in most situations.
Love it. All right, Aaron, what else you got? You got any other questions we want to hit?
Aaron,
This
you
is
had a
going to
good
be
question,
recorded
right?
for
Yeah,
those of you. I don't know if we said that. This is going to be recorded. It'll be up at directedira.com.
Yes, we'll send out a notice for that. Everybody will get an email. We'll get the slide deck, the recording of this. So all good. Have no fear. We got you covered. Okay, let's talk about any leveraged debt.
People don't want to leave, Chris.
Yeah,
we're at overtime and they're not going anywhere.
They'll just stick around.
No, this is actually...
We have hundreds still alive on with us.
Yeah, this is actually a really good question. The question is, talk to me about leverage. So first of all, a couple of things that I want to share with you is I love debt. Like if I could literally sign a document today for $100 million of debt, I would sign that.
Dave Ramsey is going to be running over here pretty damn fast.
I want to be really clear. I want to be really clear. This is my warning. If you watch me on social media, you're going to see that Kris Krohn is nice to everyone except for Dave Ramsey. Dave is my arch nemesis.
Now, Chris.
Listen, I'll tell you. I don't believe you should ever pay off your home. I'm
your
too
credit
much.
cards, okay.
I'm too much. No, consumer debt is one thing, but debt that makes you money is something that you want to have a lot of. And a lot of people, until they're on the business side of the fence and they're only consumers, they don't understand the game of debt. Debt has just been taught to be a bad 4-letter word. Debt is a beautiful 4-letter word. I love debt. And so let me share with you my philosophy in real estate. Often, if we're buying outside of a self-directed account, we generally put 20 or 25% down. And that level of leverage is going to increase my ROI. If I just bought the home cash, guess what would happen to my ROI? Would it go up or down? It's going to go down. So when self-directed accounts largely populate one of my funds, what I do is I go out and negotiate really good deals and I buy them cash. But when I buy all cash, guess what happens to my ROI? It goes down. And then I go to very, very specific large lenders and through the game, I'll put up a personal guarantee and they will allow me to leverage my fund up to like 60%, which means that I still have 40% paid off on entry-level single-family homes below the median. I would take on more debt if they would let me, but they're very conservative. And the reason why I'll borrow that 60% back out is because I'm going to go buy a bunch more paid-off real estate, and I'll do it again. And so I end up having about 50, the way it balances out is usually about 50 to 60% of the portfolio is paid off, which on entry-level real estate is a very, very safe position. But I do that to increase my ROI.
Okay, so cash balances, Matt, sitting in a self-directed IRA, earn interest while waiting for the real estate investment to occur?
You have to repeat that.
What?
Was
Was that a question?
Yeah.
Oh no!
Yeah.
You don't move money to us to not invest.
Yeah.
Open up an account with us, and you might have money sitting there before you have a deal going. But and you could open a brokerage account. There's other things you could buy stock with us and stuff. But you know what? Directed IRA, we're designed to hold an alternative asset.
Yes.
And so come to us when you're ready to buy an alternative asset. You want to buy real estate. You want to invest in a private equity fund. You want to invest in a real estate fund. You want to do private money lending. You want to invest in a small business. These assets we're always talking about. That's where you come here. Don't really park your cash here. So that's. I don't know if that answers that question.
Or Kris Krohn's going to get mad with Matt and Aaron because there's nothing worse than earning nothing on your money that is supposed to be doing something.
Well, here's the thing. I don't want you to feel like you're actually doing something by leaving money to get just a teeny little bit of interest like the banks have confused you to think. Go invest it.
Yeah.
And it's okay too. We do have a lot of clients that are like, hey, Matt, let me move over like $5 or $10 grand to get my account open. Maybe I want to do an IRA LLC because I want to do some deals and do some other things in it. I want that checkbook control. But I got really 300 grand. Okay, leave that in the market or do whatever it's doing. Maybe it's doing well, but let's get started so you're ready when you find a deal. And then we can move the rest of the money over to close the deal out. And so don't feel like you have to move every penny immediately if you don't know what you're doing.
I want to speak to that for a second because, it's the chicken or the egg. And it's the question of do I move my money over and then hope I find something? When you pick up that document that's on the screen and you reach out and my team connects with you, part of what's going to happen is, can you guys put that up? Thank you. So what's going to happen when you get that is they're going to reach out and say, do you want a game plan? And they're just going to ask you, tell me about your finances. And let me share with you kind of Kris Krohn's predictions on his averages on how much money he thinks that you can make for retirement. And when that makes sense, there's a lot of people that are like, okay, I'm going to move forward and partner with Kris. I'm going to pay his real estate partner a one-time fee. We're going to start buying real estate together. And now there's a reason to self-direct and they know how much they want to self-direct. So, sometimes it is a matter of finding the investment first. in my case, this has been tried and proven over the last 20 years with hundreds of partners on 6,500 deals totaling over $2 billion in real estate. And it's been consistent through the best markets and the worst markets. And every time in the last 20 years, we did in 2008 experience the worst real estate market people claim in the Great Recession since the Great Depression. And during that's when we made the most money. I pray, I don't really, but like I pray for recessions, I pray for depressions, and I love awful economies because the bigger the problem, the bigger the solution, the more money to make. And right now the government does a really great job. Let's go, Brandon, right? The government does a great job messing things up, and when they do, what that does is it creates an opportunity for the cleanup crew. You're learning about being the cleanup crew today. We're the one that's fixing the economy. We're the small business owners, the backbone of the 50% of the GDP of this nation. There's a reason why the IRS favors everything that my business does in the game of real estate, because we are infrastructure to the country. You're providing homes to Americans. It's actually so important to them that it's the number one tax write-off period. And that's what you're doing when you actually enter this game. And yes, done correctly, it is very profitable. This is something that's going to take care of your family, and that's why I love it.
All right, Kris, we did ask the question from the person that had the $600,000 account. So I want to ask the question from the person that only has about $50K. And Renee says, I only have about $50K with my self-directed Roth. Is that enough to do anything?
$50K is enough to do a deal in my world. That's a real estate deal. The answer is, of course it is.
And you know what? That's why just because you're asking that question, that's where hopefully this education, this content from Kris and his team can be helpful, is because you can learn how to start using that money and putting it to work.
Yeah.
All right. Well, this is going to be recorded, guys. There's been a lot of questions about international real estate investing.
Yeah,
Maybe we need to do something on that.
Can I, since there's a lot of questions, can I say something about it?
Yes, I was going to ask you, do you do that? Or
I don't invest internationally, but I'll tell you what, show me an international market that can consistently provide deal flow with ROIs based on a track record that outperform my ROIs I've shown you tonight. And guess what? I'll be interested, but you're not going to find that. That's just the fact.
Matt, let me hit a
So I just want to say, why would you do it?
Yeah.
And because this is weird. We have these sycophantic fantasies where but I want to own real estate in France, or
that was one of the questions.
I want to feel like I did something, or I'll go one step worse. There's the people that are like, well, I want to get into Airbnb. I'm like, why? Well, I kind of have a favorite destination, and I want to own a house there, and then if it's Airbnb, it'll make sense. I'm like, hey, here's a good idea. Go put your money where you get a superior ROI. Yeah. Take the money it makes you, and go Airbnb anywhere you want in the world. Ownership is overrated. This conversation is about ROI. Stop getting fixated on earning certain things. By the way, if you are international, I do want to answer that. Yeah. Then come invest in America through me. I have partners all over the world, in countries all over the world that are my partners. And guess what? I help them invest in real estate here in the United States. So if you're international, it doesn't matter.
Okay, so if you are, with your IRA, everyone, you're not doing physical work on properties or those investments, you can play an administrative role, but you're not going up and picking up a hammer and stuff. So just
better not get on an airplane and go check out that property. We got something called Google Street View.
Yeah, just hit that. So Captain Glenn, another great one. You just were on a roll today. Congratulations. He asked a very good question. How long is the process of rolling over money from an IRA fund to get it into a self-directed IRA account? It just depends. If it's an existing IRA, let's say at like Chase Bank in a CD or something, you can do that pretty quick, typically in about a week. But if it's with an old employer plan, old 401k that you had previously that has a different administrator, that could take up to 2 to 4 weeks to get that over. It has nothing to do with us. It has everything to do with them. You got to contact them, get the money over, and then they're either going to send a check to us or to you directly, and then you got to forward that on to us. So we'll help you. Don't worry. Just schedule a call. We're going to get you situated. We'll walk you through the process, but it could take up to 30 days to do something like that with an old 401k. But let us help you do it. It's not the end of the world, for sure.
Okay, let me say this because we have a ton of questions here that we need to do a webinar on just self-directed IRA rules and strategies. So
do we know the person that wrote the book on it?
Well, see, this is the thing. I was just saying I've been ducking those questions because I want to get Kris's expertise while we have them. So like Bill and Brent and many of you guys that have asked a lot of more IRA questions, I'm trying to get the content out for Kris. So don't hate me. I've ducked those intentionally, and I feel bad about it. but we're going to come back. We're going to do another webinar, and we're going to start doing more open forums actually and get live questions. That's my commitment to you guys. I love doing that anyways. So, and Tristan's here and is going to hold me accountable to it because he can schedule it and get it done. But all right, we did have a couple other questions, and then let's wrap it up if you don't mind, Kris.
Sure.
You got a couple more minutes?
I got a couple more minutes.
Okay. And I don't know if you want to get a final question on your end, if you got any others that are dying, Aaron.
Go for it.
Okay. Marsha asked, what is your real estate partner one-time fee? I don't know, what's the fee? Is it profit sharing?
Yeah, great question. So when people invest with me, it depends on how much we're going to do. So one of the things that we talked about earlier is in the game of real estate, you have commission people, and then you have a bunch of unlicensed non-commission people. The majority of people on my team of 200 experts that are researchers or they're managing rehab, for example, these individuals don't have a commission and they don't have a way to get paid, and they don't have a way to get paid out of a deal. So when I set up the system, I basically said, I'm going to help enough partners do this in bulk so that I can really bring those fees down to something very, very inexpensive. And so there's really two fees that are important. The first one is when someone partners with me, there's a setup fee. And the setup fee depends on how much real estate that you want to buy, because it determines how much of my team is going to be engaged. Then the second fee is there's a small fee applied to every house that we do, because I got to find a way to pay all of the people for the work that they're doing that I can't wrap into the deal. Now, even though we're able to wrap it usually into the deal itself when we negotiate the deal, this is a real business. And a lot of people don't understand that. Real estate is not an investment that's passive. It's a business, and that business has a very active component. And so I used to run it mom and pop shop where I had a handful of people. We did the best we could, and then I got what I paid for. Today, I have the best of both worlds where I have an incredible, robust, highly educated team, the best team I've ever had. But because I have enough partners, it's able to really bring those fees down to something pretty small. But I will tell you, when people partner with me, when you contact my team, they're going to give you all the details. And there's some of you here that might say, I want to buy 10 homes right now with Kris. And I'm doing that for acceleration, and I'm doing that because I believe Kris's prediction in the next 2 years won't happen. And I feel like there's an easy $1 or $2 million that I can pick up, so I want to ignite and go fast. But there might also be someone here that just says, I got to get started with just one home. That's what I have money set aside for. And so what I've done is I basically created tiers of what it is to partner with me, and my team will go over all those details with you and really help you understand what they are.
Makes sense.
What else do you got, Matt?
All right, Gerard asked, do you do any new construction? I think you showed a new construction, or any limit on extent of rehab.
Yeah, so here's kind of the cool position I put myself in. I don't own the property management company. I don't own the title company. I don't own the loan company. I don't own the rehab company. I used to do this many years ago, and I got rid of them. And it's not because I'm an idiot that didn't want to make extra money from profit centers out of the other parts of the businesses. It's because I needed to be able to hold everyone accountable without having an interest in those companies. And so what I do is I hold people's feet to the fire for performance. And that means that everyone has to perform, and that's how I get my ROI, which means that I'm in it as an investor to make money as an investor. I don't pick up extra money from playing any other hats of realtor, loan officer, or any of these other things. We don't make any money that way. And so that means that I get to be in a, if you will, a fiduciary type of capacity that says, hey, you found a deal, you rehabbed it, it ended up costing you $13,000 more than you wanted, and that broke my numbers, and I got news for you. I don't want to buy it anymore. And they have no recourse. And it's a gentle way of flipping them the bird that just says, I love you, but if your numbers don't line up, you eat it, not me, because my partners, I deserve the best. And so I run my business in a particular manner that allows me to basically be very, very choosy so that I can find the very best investments and not have any alternative motives. And that means that everyone has to perform for me.
All right, this is going to be the final question.
All right.
And this was a good one because someone's asking about Kris's demise.
Oh, I like it.
What happens if Kris retires?
Yeah, so first...
Since this is a long-term investment, is there a contingency plan in place? This is Kris Green asking.
Yeah, so Kris, I appreciate that. If you follow any of my social media, you learn that I'm going to live
140.
to be 144. Oh! Aaron, you're so close. You're so close. So I literally, I work part-time, and my life is built around biohacking. And I do bodybuilding competitions, and I'm basically the healthiest I've ever been in my entire life. Strong, fit, fast, loving life, and a bus could hit me too. So, so in owning hundreds of businesses, I actually have an entire estate plan, an entire structure, a board of directors, a board that is over multiple boards of directors for multiple companies. And for the sake of my own wife and kids, let alone my partners, I basically set up a system where everything has a continuation plan. My real estate, it's a continuation plan. My social media, like we are a couple years away from social being AI driven, but maybe I won't make it to then. I don't know. So yeah, something could.
Chris Robot.
Yeah, Chris Robot. So you don't even know if it's really me standing here, do you? Pinch me. That's AI right there. No. Does AI have one of these? No. So the thing is with, I basically have, my estate has the ability to go on. At some point, I may not get new partners or anything obviously like that, but I have the way to service my partners indefinitely. And here's the reality. I basically spend a couple hours a month connecting with my partners through text. And then they come out to our partner live events where I train with them. And outside of that, I actually live by my own philosophy. If you want something done right, don't do it yourself. I have a team that does everything for me, and that team will continue existing and doing everything for you.
I think we provided a ton of value today. I hope everybody enjoyed this. We love what we do.
Yeah,
Myself and Matt,
Yeah.
we love self-directing. We love helping people take control of their retirement and invest in what they know, what they love, and really own it. And so this is a lot of fun to us. If you want to learn more about Kris, go to thekriskrohn.com/more. If you need help and have a bunch of questions on the directed IRA, self-directing stuff, please go to directedira.com/appointment. You can get a discount by doing Krohn Webinar 100. We'll totally hook you up with that. It's a free call. We'll help get all your questions answered and help you out with that. And again, with Kris, connect with him at kriskrohn.com/more. What else? Take us home, Matt?
Yeah, I just want to say thanks to Kris. Thanks for his team here in the studio.
They
We
are
got to come
awesome.
in here. It was awesome to meet Kris and for him to share his wealth of knowledge and information with us. We're going to be back next month with the Directed IRA webinar. But remember, we're going to be doing some lives. Make sure you're subscribed to our newsletter at directedira.com. You've got to be subscribed to the newsletter because we're going to be coming out with a lot more content. We ducked a ton of questions, which tells me we need to get on and do more of this content.
Amen.
Make sure you're listening to the podcast. A lot of you are asking square one questions. I have to say, I've got an entire podcast episode on that. Mark and I have done a podcast episode on freaking every question here. We just got to help you guys get that content. So please make sure you sign up for the webinar. We're going to be back with an amazing webinar next month on the Direct IRA webinar. And thanks so much, Kris, and the team here at is this Krohn Studios?
Let's
call it that. We're calling
At Krohn Studios.
It's Captain Krohn Studios.
Captain Krohn Studios. It was an honor. And thanks everyone for being in. Everybody with your great questions. We'll see you next time.
See you, everybody.